How are you, Melissa?
I'm okay, thank you. How are you?
I'm okay. So I've got a Zoom question for you.
Mm-hmm.
Jenny and I are on Teams while I'm talking to you. When she set up the meeting in Zoom, she set me up in our accounts as a co-host.
Yes.
Well, Greg Meese needs to use my account for an Odyssey Charter School meeting starting at 3.
Well, okay, won't we be done by 3? This is only an hour long.
Well, since it's starting at 1:30, I would assume that we will, but to be safe, Jenny pointed out, we really don't want him signing in and all of a sudden bumping us out some way, shape, or form. So my question was, how do I show up on your screen? Do I show up now as a co-host or just as a participant?
You're just a participant.
So
I can make myself the co-host if that makes more sense.
So what I'm thinking is we go into the exec admin and don't make me a co-host in there and just let me sign on through my email, and then you as the host can make me a co-host live.
Well, why? So, okay, why does it matter if you're a co-host if we're logged in through the exec admin account?
I don't know, but Jenny rightfully is concerned that if Greg logs in early and we aren't done with our meeting, it'll do something to screw up our meeting.
Well, if he logs into your account, it will simply kick you out, but
you're both
because
Melissa said if he signs in, it may kick me out. It won't kick everybody else out because it's on the exec admin login.
Yeah, so we went outside. It was really windy, but it wasn't.
So I think we're good.
It's kind of nice, actually.
I think we are good, yes.
So we went outside, just sat outside for a bit.
Thank you very much.
Oh, you're welcome.
I can't see myself. Can you see me?
I cannot.
Interesting. I can't see myself on the Zoom meeting.
No, there's no video there for you.
Mine says stop.
Oh no.
Oh, you're allowing video. Maybe not.
I got to do the same thing. So mine does the same thing, so I don't run into a different one.
Say hi to Hoppy. I hear him in the background.
Yeah, he's on a call himself.
Yeah. I need to call electrician because our.
All right. Well, thank you for letting me in.
Oh, sure.
I'll sign out and I might as well just leave myself in.
Yeah, I would just leave yourself in. That's fine.
I'll just mute.
We'll get started soon. Just remind everyone, if you were able to please mute, and we'll be getting started shortly. We're just waiting. We're just getting a couple more folks that are signing in. I want to make sure they all get in before we get started.
Okay, Sheila, I think we're okay to go ahead and get started. We're at 1:30. Just want to be mindful of folks' time.
Exactly.
All right. Thank you, Melissa. And again, just ask folks, if you don't mind, please mute. We are, as a reminder, we are recording this session for those who may be interested to view later. We also welcome your questions, but we'd like to do that at the end. There is a chat box at the bottom that if you want to type in your answers, Melissa will be sorry, I said type in your answers. If you have the answers, that's great. But type in your questions in the chat box, and Melissa will capture them as we go along. And then we have definitely made some time at the end so that you're able to ask the questions that you have. So I want to welcome you all to this session on economic outlook for nonprofits, and really want to extend a big, I have to get my thing here working. There we go. Extend a big thank you to Wilmington Trust and M&T for not only providing our speaker, but also to help underwrite this event. So a big thank you to them. For those of you who may not be familiar with Dana, we are a nonprofit and our mission is really to help advance nonprofit excellence in Delaware. We provide that through a variety of programs, including leadership development programs, board development, and provide consulting and learning opportunities around sustaining organizations. We also are an advocate voice and pride ourselves in being an alliance of over 400 nonprofits, philanthropy organizations, and businesses in the community. And I have to say that in these last couple of months, or a couple of weeks, we've been very focused on the COVID-19 issues and trying to provide resources to you. Again, I just want to extend a very big thank you to M&T and Wilmington Trust for providing this program today. So our agenda is very simple. I'm going to turn this over in a couple minutes to Rick Murad, who's going to introduce Megan. She's going to provide us a perspective on how her organization sees the world and some factors that influence what the economic profile might look like in the future. And then I'm going to do my best to kind of summarize it and bring it back into the context for nonprofits. So without further introductions, I guess I'll start with Rick Murad. And Rick is a product manager for Wilmington Trust, but even more special about Rick is he is a Dana board member, and just really thrilled that he joined our board. I guess it's been almost a year now, Rick. And so with that, Rick, I'm gonna turn this over to you, and you can take it from here.
Sure, thanks, Sheila, and also some thanks is certainly due to you and to Dana for helping to organize this event. So, first and foremost, wanted to thank you for helping to put this on. I know that you and the team at Dana are working extremely hard right now to support the nonprofit community in Delaware through the pandemic, including more than probably your fair share of night and weekend work. So first and foremost, thanks to you and to the team for all that you're doing. And similarly, thanks to everybody who's joined us today from the Delaware nonprofit community. Thanks to all of you for all of the hard work that you're doing as well. I know that what I just said about Dana is equally true for you. And so we appreciate you guys taking the time to listen to one of our subject matter experts today. And again, for all the work you're doing. I know I speak for myself and for M&T and Wilmington Trust when I say that the work that the Delaware nonprofit community is doing is vital to our Delaware community, both socially through the missions that you champion, as well as economically through the jobs that you help to create and to support. And so it's vital that this work continue, not just in spite of the pandemic, but arguably this work is even more important precisely because of the pandemic and the hardship and the hurt that it's putting on so many people. So we want to help, insofar as we can. And today we're hoping that we can do so, at least in some small part, by having one of our subject matter experts and thought leaders talk a little bit about the economic picture, and with Sheila's assistance, help kind of distill that down into what it may mean for nonprofits. There's a lot to take in from the economic picture. There are a lot of scary headlines, a lot of scary numbers coming out seemingly on a daily basis. And we all know that it matters, but it can sometimes be very difficult to distill what that means and what makes sense and what it means for me from the standpoint of a nonprofit, particularly to the extent that it's not something that nonprofits are generally in the business of living and breathing day in and day out. So to that end, it's my pleasure to introduce our head of investment strategy at Wilmington Trust, Megan Hsu. If you're a regular watcher of CNBC, you might recognize her, but Megan, as head of investment strategy, helps to manage our asset allocation process, which is how we allocate assets between stocks and bonds and the various other asset classes. And in this capacity, she also helps to develop market research and to develop and communicate our investment team's market outlook, taking into account economic forces, market activity, things of that nature. So we're very grateful to Megan for taking some time to speak with us today. We definitely consider her one of our thought leaders, and it's a real pleasure to have her today. So Megan, thank you very much again for taking the time today. I will get out of the way here and let you do your stuff. But once again, can't thank you enough for being here. So thank you.
Great. Thank you, Rick and Sheila and everyone for joining today. I'm really happy to be here, and I appreciate the opportunity to speak with everyone about the view that Wilmington Trust has of the economy, everything we're going through, and importantly, as it relates to what I do on a day-to-day basis, how to translate that to the investment world and the market landscape. So Sheila has pulled up a presentation here, and I have some slides, some visuals that I think will be helpful in telling the story as we see it. But it really is clearly an unprecedented time that we're living in, and there is simply no historical analog that we can look to as a guide, particularly with the scale of what we're living through today. You know, as an investment strategist, we frequently will look at historical data, historical recessions, trends, patterns to try to anticipate what might happen in the current environment. And it's just really difficult. So we do have an economic framework that I want to walk through that I think will be helpful in evaluating the economy on a bit of a moving target basis. And so I will start with the economics. And as we look at markets, and specifically the equity market, which we see as being torn a little bit between some very negative economic fundamentals and unprecedented levels of stimulus. So thank you, Sheila, for pulling up. This is kind of the takeaway in a nutshell. I'm not going to go through everything here on the slide. But if you want to, yes, perfect, land there on the core narrative. In terms of the US, we are expecting a very, very deep contraction in the US economy in the second quarter. We've already gotten a taste of that with the first quarter GDP at nearly around negative 5% on a quarterly basis, which is a very severe drop. And we know it's going to get a lot worse because most of the economic fallout and containment efforts for the virus are occurring in the second quarter. On top of that, we have the oil markets, which are caught in a extreme level of oversupply. And so we're looking at really historic kind of anomalies when it comes to the pricing of oil, negative oil prices, things of that nature, things that don't seem to make a whole lot of sense and we haven't seen before. So unprecedented times when it comes to that. Globally, we see the fallout, not being limited to the US. Some areas of the world like China that are further ahead on the curve, they are in the recovery phase, but if we're able to look at them for anything, we see whether it's China or Germany, the recovery there is occurring very slowly. And so for us, that means that in the US, we do expect this very deep contraction and not the V-shaped recovery that so many hope for. That is to say, a very sharp pullback, but a bounce back quickly thereafter. We have seen that V-shaped pattern in the equity market, but as far as the economy is concerned, we expect the recovery to be a little bit more delayed, a little bit more gradual, starting to recover in the second half of the year. That is still our expectation, but we think it's going to be a little bit choppy, a little bit bumpier than many are expecting. And so as we look at this economic backdrop that's very negative, we have to weigh that against what is equally unprecedented amounts of stimulus, both at the fiscal government level as well as the monetary level. So I'll talk about that as well. So Sheila, if you want to advance to the fourth slide, this is how we have approached trying to anticipate what's going to happen in the U.S. economy over the next year or so. This, you know, there's a lot of guesswork that needs to go into a number of variables related to the COVID-19 virus, the spread of the virus, and the levels of containment or quarantine that we have at a national level. So what we did to try to approach all of this uncertainty was to create a scenario analysis. And so we've looked at, on the left side of this table, 3 levels of containment efforts. Level 1 being the kind of what was the current level about this time, about a month ago. Current level, which was roughly 2/3 of the country under some level of lockdown. Level 2 being the mitigation efforts in the most affected areas, think New York, think the Northeast, where we were really feeling it most severely, those being extracted all nationwide. And level 3 being the strongest containment measures, that is full lockdown, nothing open, everybody pretty much sheltering in place. That would be level 3, the most severe containment level for this virus. And so we plotted that against, we used our economic models and really a line by line analysis of every sector and industry of the economy, what we expected the fallout to be under those different levels of containment. And this is where it's really critical, both for the economy and for markets. We can make an assessment of the level of contraction under each of those levels, but the important thing is the duration of those containment efforts. The shortest realistic one, which we've already blown past, is the 30-day containment, and then we took that up to 90 days. And then the most extreme that we've looked at in this scenario analysis is 180 days, which would be get you to the later part of the summer in terms of lockdown remaining in place. And we're already seeing some areas lift. This is a simplification. So you have to realize that what complicates this a little bit, some wrinkles, is that we around the country went under lockdown all kind of at different times. Similarly, we're likely to come off of lockdown in some gradual manner in different patterns. So some states opening up before others. The gist of it is that if you look at where you would be under these different levels of containment and the various time frames that these levels of containment may remain in place, you're looking at where we would triangulate as the most likely is somewhere between level 2 and level 3 for somewhere between 30 and 90 days. And so our expectation, Sheila, if you want to go to the next slide, is that for 2020, we're probably looking at a contraction of GDP between 3 and 5%. This would be the most severe economic contraction we've ever seen. We're likely to see unprecedented levels of unemployment. If you want to go to the next slide, I can talk a little bit about that. We've had really an astronomical surge in initial jobless claims as companies have shut down, they've furloughed workers, they've laid off workers. And our expectation is that the unemployment rate will probably be at about 15 to 20% in very short order. So the highest unemployment rate we've ever seen in this amount of time. So this is kind of the severity of the situation that we're looking at. And clearly this data here on this slide showing initial jobless claims, these come out every week. So they're the best real-time indicator that we have of the labor market. You can see the scale of this chart. The current situation is literally off the charts. So that is kind of the, as Rick was suggesting at the beginning, these very scary economic numbers we've never seen before, or we don't really know how to calibrate those into what they mean. And the positive to offset all of this negativity is that we are seeing, and we have seen, an unprecedented level of fiscal and monetary stimulus with a speed that has been much faster than prior recessionary periods. So if you want to advance to the next slide, Sheila. From a fiscal point of view, this did take a little bit longer than the Fed's actions, and I'll talk about those in a minute. But the U.S. government passed in excess of as of today, about $2.5 trillion worth of stimulus. Most of that coming in the form of either unemployment benefits to households or loans to businesses. So this is kind of a fun graphic that shows how that $2 trillion CARES Act stimulus package that was passed last month, how it's broken down. Again, on the left, most of it, about $900 billion, coming in the form of business loans, some backed by the Treasury, about $550 billion of the stimulus package going to households, and then other tax provisions, support for airports, education, municipalities, things of that nature. So about 10% of GDP. This is an unprecedented amount of fiscal stimulus that has been, and I think one of the main, it was for the speed with which it was put together. The main goal is to support businesses, keep them liquid, keep them operational, so that when the restrictions are lifted, there are jobs to come back to. Part of the small business loan program is really unique in that if businesses use those loans that they take from the government to keep payroll, to keep workers on the payroll, or they hire workers back by a certain date, I believe June, sometime mid to end of June, then those loans turn into grants. So really, really generous benefits. We are, combing through all sorts of industry reports, trying to see how this stimulus is making its way into the economy. I'm sure you've seen some reports about maybe companies that shouldn't have gotten it or didn't need it receiving some of this aid, and maybe it not going to the right places. There was a second round that was passed by Congress, and I think what we're seeing is both on the fiscal as well as the monetary, just throwing everything at the wall. And if there's a maxing out of these loan programs, we're seem to be getting assurance that Congress will go back and try to find more money. So that has some long-term implications for the debt, which we can surely talk about. But for the time being, the response in the form of support to businesses, to consumers, has been kind of a light for specifically, and I think a big reason why equity markets have bounced back in such a resilient manner. So as impressive as the fiscal stimulus has been, if you jump to the next slide, the response from the Fed and central banks has been even more dramatic. The Fed is really, as this slide says, the Fed has pulled out all of the stops. The Fed took the Fed funds rate to zero almost immediately after it became clear that the virus was spreading in the US. So this was a very rapid pullback of the Fed funds rate. And shortly after, the Fed began to embark in QE and various other stimulus and support programs. So if you want to go to the next slide, quantitative easing is essentially the Fed purchasing assets, treasuries, mortgage-backed securities onto their balance sheet to help lower interest rates and support really a lowering of the interest rate environment, supporting risk appetite for kind of moving out the so-called risk curve, and encouraging the continuation of borrowing and liquidity in the markets. So the Fed has really what was been so helpful this time around is that the Fed had a lot of these tools that took a long time to work through and develop in the global financial crisis. Now they had them more or less at the ready, and were able to pull them out fairly in very short order. So you can see here QE, and we're in, sorry, the order in the legend is a little backwards, but QE 1 through 3 essentially occurred during or in the immediate aftermath of the global financial crisis. This was, a very large scale asset purchase program by the Fed. And what we've seen in just 4 weeks is more purchases from the Fed than during any of those prior rounds. Again, in a very, very short amount of time. This has been very helpful for maintaining liquidity in the markets, keeping interest rates from increasing materially, and impairing the ability of companies to access capital. Again, the idea being we want companies to be able to access capital to keep the lights on so that when containment measures are reduced, you go from a code red to a yellow green, then you will have businesses to go back to, jobs for workers to go back to. I'm not going to talk about all of these, but if you go to the next slide, this is a really, I think, a good depiction of the many things that the Fed has done. Everything from Main Street lending programs to purchasing of municipal bonds, things that the Fed has never done before, to be honest, things that we, as kind of people who watch this type of thing very closely, we're not even convinced the Fed has the legal authority to do some of the things that they've done. But at this point, nobody's asking questions, and it's almost a, shoot first, ask questions later, or ask, better to ask for forgiveness than ask for permission at this point. A lot of support being given to the markets and to companies. And so this is kind of where you can see the extremes, and we're faced with these extreme, this extreme level of economic contraction, but also this extreme level of support that we've never seen before. And we find ourselves basically having to rip up models and try to come up with new ways that this will translate into the economy and into financial markets. I'll pivot from the US to the global environment briefly. And this is, as you may imagine, what we're feeling and experiencing in the US is something that is being felt around the world. Here we look at a global market. Market is a company, so that's not a typo. It's a company that spells M-A-R-K-I-T. This is a manufacturing and services PMI, a purchasing managers index. Essentially what they do is this is a company that surveys businesses, specifically the people who are closest to the decisions to expand production, to expand inventory, people who are actually purchasing supplies, and really part of that supply and demand chain. And they ask them, are you seeing a series of questions to try to discern if their business is expanding or if it's contracting. And this is what we call a diffusion index. So if the number here, either the green line or the purple line, is above 50, that indicates that in aggregate, businesses are expanding. And if it's below 50, in aggregate, businesses are contracting. That's not necessarily a number below 50 means a recession. It just means that economic activity is slowing and moving kind of in the wrong direction. Early days, again, because a lot of the most stringent lockdown did take place in April, in the month of April. But we have seen the sharpest drop in this PMI indicator at the global level. Manufacturing fell significantly, but where we've really seen it is in the services, as you might imagine, without being able to go to restaurants, without being able to go get your hair or nails done, all of these services that really rely on close contact. And I believe this is the lowest we've ever seen this measure of the global economic activity. So a very deep economic contraction at the global level as well. We are seeing, similar to the Fed action, I think the Fed has been the fastest and most comprehensive of central bank responses, but central banks around the world are doing what they can to ease the pressure and improve liquidity. So if you want to go to the next slide, this one kind of just highlights at the monetary level and the fiscal level, some of the steps that have been taken across the major economies: China, the Euro area, the UK, and Japan. The Euro area, unfortunately for the Euro area and Japan, these areas of the economy were already quite weak, and we were seeing they had already, coming into this virus, re-engaged in quantitative easing and asset purchase programs, trying to support what was a very low level of inflation, teetering on actually deflationary conditions, which central banks are generally striving across the world for somewhere between 1% and 2% inflation. So steps have been taken. We do think that this is going to be a gradual recovery. And a lot of it does depend on the science, which we'll talk about in a second. Just kind of another visual for how to grasp the response of central banks. If you go to the next slide, I like this one. This is another kind of diffusion index. This is an aggregation of global central banks. Okay, so looking at central banks representing about 95% of world GDP. And if the bar is above, the gray bars are above 0, that indicates that there are a certain number of central banks actually tightening monetary policy, raising interest rates. And if it's below, that indicates central banks are cutting interest rates. And you can see that the number of central banks cutting interest rates is the highest since we have data for tracking for this particular series. We have a more accommodative, more supportive response from central banks than we saw in the depths of the global financial crisis in 2008. So if there's any kind of offsetting factor to what we know is a very bleak economic picture, it's that policymakers are by no means sitting on their hands. They're doing what they can to support liquidity of the markets, and it has been doing its part to, we see it in corporate credit spreads, high yield credit spreads, and other measures of market liquidity, that the picture has improved since these central banks took action. Shifting gears a little bit, I want to talk a little bit about the oil market, because this is one area that in some senses is a bit of the straw breaking the camel's back. When we came into this year, before the virus was upon us, we were looking at a global oil market that was going to be fairly well oversupplied. So what that means is supply marginally exceeding demand, some downward pressure on oil prices. We think of, as consumers, oil prices being low as a good thing, and it usually translates into cheaper input for airlines and cheaper airline tickets, cheaper gas prices at the pump. But what has changed actually in the U.S. in particular is that over the past 10 years or so, the U.S. has been producing much more oil, and we have seen the U.S. economy become much more reliant on production of oil, such that lower oil prices are no longer the net positive for the U.S. economy. What we see is that lower oil prices can actually put a lot of pressure on the manufacturing sector. And we are currently at what we're showing here. The price of crude oil is well below what we think of as the range of break-even prices. That is the price of oil that companies need in order to stay profitable and continue operating for an extended period of time. So at these prices, if we remain here, which with the shutdown of demand, we are likely to be well oversupplied for some time. We are looking at severe pressure on U.S. oil companies and the spillover effects to the U.S. manufacturing sector. So I'm going to, I think maybe I'll pause there. Sheila, maybe if you had some comments that you wanted to bring in, and then I'm happy to talk about kind of any other topics or answer questions that anybody might have.
Great, thanks, Megan. I'm going to put my slide back up. Oops, I have to share it. Can you see that? No, you can't. Let me go back here. Here we go. Yeah, so one of the things I am going to attempt to do, and I am by no means an economist, but try to say, okay, well, so how would we think about that as it relates to our work as nonprofits and thinking about how we plan for the future, because ultimately, you know, that's really what we're being tasked to do. So not that history is going to predict the future, but perhaps we could have a little perspective on history. And one of the things that struck me with what Megan had shared is how different this current situation is compared to the Great Recession, as we call it. And one of the things that I just wanted to point out is that even at the height of the Great Recession, unemployment in Delaware, I think it topped at about 10% in late 2009, but it took almost a year to get to the high unemployment levels that we experienced in the state. And then, of course, it took many years for us to get back down to the levels of unemployment that we had back in 2008 or 7, I guess it would have been. So one of the questions or things for us to consider is how long do we think that the level of unemployment is going to take place. The good news is that, from what Megan's sharing, is that all of the stimulus money is designed to reboot, right, the economic situation to get companies back up and running. But to what degree those companies can get back and running to a level that they can bring back their employees is certainly something that maybe Megan will talk about later, but at least, you know, just for us to think about what that might look like, and particularly for nonprofits that provide critical services to individuals who have lost their jobs or who are in the business of helping those who are underemployed to get to new types of careers. It seems like this could be a high demand area for the next couple of years.
Yeah, Sheila, actually, if I could, that's a great point and a great question. So maybe I'll just jump in quickly and provide 2 thoughts on the unemployment rate, because you've raised a very good point. A big aim of the fiscal stimulus we've seen is to avoid the scenario that you're showing here, which is a very long recovery back to prior low levels of unemployment. They're trying to essentially, as quickly as the switch was flipped to take everybody off the payroll to put them back on. Two kind of problems that in practice make that process take a little bit longer. One is the sort of chicken or the egg situation, which is that if somebody doesn't have a job, they might be less likely to go to a restaurant. And so that restaurant has less need for the employees. And as a result, they're hiring fewer people. So there's less money in for consumers to be spending. And so you kind of have this vicious cycle. That takes a little bit of time to work through historically. And then the other slightly cynical view, I'll just put it out there, is that the unemployment benefits are extremely generous, far more generous than they were during the global financial crisis. And you have a good chunk of the working population making out better on unemployment benefits as they are outlined today, and these current ones last until, I believe, July. People making out better than if they had returned to their prior jobs. And so you have to think about, well, could this have the effect, just from an economic point of view, of slowing down the return to work and the people's desire to return to work? And then when those unemployment benefits are set to expire in July is shortly before a presidential election. So you run into a difficult situation where, you know, it's hard to see the president ripping at that, you know, rug out from under workers right before an election. So two things that we think could lead to an elevated level of unemployment through the end of this year.
Great, thank you for that. The other thing I thought was interesting that's different this time, at least for now, is that if you look at where the stock market was, which is where a lot of people have investments, you can see that huge dip that took place during the Great Recession. And though there was a little dip, it seems like it's bouncing back. And I think that has to do with a lot of the stimulus activity that the Fed did in Congress. And so it makes me wonder, you know, even though there's, you know, this is a crisis of unimaginable proportion, am I correct, Megan, that if the markets stay good, that's going to help, because, you know, that means that, as I think you called it, the liquidity, that, you know, the cash is flowing through the system, and that means the investment portfolios and the value of the companies themselves are not going to dip to the degree that they did here.
Yes, there's a wealth effect too. People, when they see their retirement accounts collapsing, their investment accounts collapsing, that can translate into lower housing prices. All of that leads to less or reduced levels of consumer confidence and consumer spending. So we find the pullback that we saw, that's that steep drop at the far right of your graph, Sheila, that was at the deepest part, about negative 34% for the S&P 500. I don't know, looks like that might be what you're showing here. Actually, I'm sorry, you're showing the Dow here, but the S&P 500 contracted about 34%. That's the historical average for a recession. So we were right in that sweet spot. What's been very different is the market bouncing back very quickly, such that we are only about 15% from all-time highs. And to process that, if you think about how kind of dysfunctional the world is right now, how out of sorts, and how long this could last potentially. You know, again, our view is of a slow recovery, not a V-shaped recovery and a sharp bounce back. We look at that market response as being vulnerable to some choppiness and maybe some lower levels going forward. We think it may have bounced a little bit too far, too fast. Of course, part of the reason it's bouncing like that is because of the stimulus, also because of the science. And we didn't talk about that, but the global, everybody kind of pulling together to try to come up with therapeutics and a vaccine. We're getting new information every day that looks like you know, some promising therapeutic testing from Gilead's remdesivir drug. Some companies, University of Oxford, working, they believe they'll have, 100 million vaccines available by the end of this year. all of that suggests that we might be back to normal, or some resemblance of normal, perhaps a little bit quicker. And so it's hard to see exactly how it shakes out, but we are looking at a very, very rapid recovery in the market. That should be supportive of spending and people, how good they feel about the environment.
Great, thank you. That should say recession, not depression. So I did want to point out, because we saw that big drop in the valuation of the market, I think that translated a lot into what we saw with Delaware nonprofits. So this is data from Share Delaware, which is a collaborative with Dana and Philanthropy Delaware, where it's looking just at nonprofits that provide services in Delaware. To keep it a little cleaner, because hospitals and universities drive so much of our revenue and investment income in this sector, we pulled them out just to see where the impact was. And we just used a 2-year period. So kind of that pre-recession. So these are tax forms that were filed for 2007 versus what was filed for the years of 2009. And you can really see how investment income really took a hit for a lot of nonprofits. And, those agencies that had large endowments would have been impacted pretty greatly. So again, as we think about what this particular market situation looks like, it may not translate that the investment income will take as great a hit. The donation side also took a hit, though in the relative scheme of things, one thing that surprised me is just in the grand scheme of things, it was not as big of an impact. But definitely donations were driven probably by that loss of wealth that took place at the time of the Great Recession. From a subsector standpoint, for those of you who lived through the recession 11 years ago, you know that organizations that were providing critical needs definitely saw their donations increase, while other organizations saw the decreases. So the arts, as an example, healthcare, again, we pulled out the hospitals, but that might be your behavioral health, your mental health areas, and a couple of others. Last thing I'll highlight, though, is that one of the shining lights of the recession is that though donations were down and investment income was down, programmatic revenue was up. And that, again, is driven somewhat by the funding that came in for the human services side, because you had so much unemployment. So there was more money coming in there to drive programs. And so the ability to deliver program revenue is really key, because in the nonprofit sector, about 50% of revenue is driven by programs. So this becomes a key factor when you start to think about this scenario. It's a little bit different. It may not be that the investment income is going to drop as much, but we certainly, all of us, are feeling the impact of not being able to have that programmatic revenue. And then also the direct contributions, at least in the short term, have definitely been an impact. So I did want to call out, because I know a lot of organizations receive grant and aid. And Megan, this is a special bill that the Delaware General Assembly appropriates every year to provide funding out into local communities. And the years, again, pre-recession, which had been June 2007, and then post-recession, we did see how grant and aid was impacted. And that's one of the things that you're hearing in the news, is that as the state is looking at these market conditions, they're having to say, okay, how's that going to translate into revenue for the state? And what will be the state's ability to fund? Our hope, of course, is that we don't see this level of reduction. But I did want to give that perspective so that, again, as you're thinking about your plans and looking at those scenarios, for those of you that receive grant and aid, to keep in mind. So, and this is where, Megan, you can pop back in if you'd like, but I started to think about, okay, so what would that mean for us as we start to think about the mix of revenue that nonprofits provide or that generate in the sector? And one is thinking about back in the Great Recession, where we saw the dips in donations, and to what degree is that going to, in this current situation, depress I'll call the smaller gifts, and then also recognize the rise in critical services. And so for those of you that do provide critical services, how do you kind of create that case for support to really to be able to go out and secure not only the donations, but also more importantly, some of the government funding for which you're serving as a partner with. I did put this in here. I don't know if it's safe to say, but if the markets do remain relatively stable, that does mean that some of your higher wealth donors are not going to see such a big hit on their portfolio, which means that they may be able to retain their levels of giving for those causes that they really care about. So thinking about how do you continue to communicate and steward your major gift donors so that they continue to see the value of what your organization provides. We will continue to see donations directed towards critical needs until we're able to move out of a state where individuals and unemployment has started to go down. And I do think it's important to reflect on how your organization's programmatic revenue is going to be impacted based upon your organization's ability to open in the various phases that the governor, we hope soon, will be sharing. And as you know, Dana, we will certainly be raising the case for grant and aid, but thinking about what scenarios you might want to bring forward as it relates to how grant and aid may play out. So I'm gonna just kind of give an overview, and then I want to really make sure we have time for questions. But our hope today was to provide some perspective on how the experts, such as Megan, understand what's happening in the market, what is completely unprecedented, and as she said a couple of times, like the old projections and the models don't really work in this scenario when you have so much extreme measures. But at least hopefully it gives you a framework and things that you can look for as we continue through the next couple of weeks and months. I do really encourage you to look at your portfolio of programs and revenue mix and really say, what are the things that we create the greatest value for? Because that may allow you to redirect your resources to those types of opportunities. Creating scenarios looking forward and understanding what your revenue and expense projections look like. If you don't have that resource, we do offer that as a tool. And again, thinking about, is there ways, one of the things that has amazed many of us, including myself, is how quickly we all were able to pivot and begin to work remotely, and more importantly, provide services remotely. And so what lessons can we learn from that? Are there new ways in which we can operate and do things differently that may be more efficient in the future? And then finally, just how important it is to tell your story. Tell your story of what's happening with the work that you're doing today, the community impact you're doing today. And then as you are emerging out of the situation, in what ways you're rethinking your work so that your donors and your clients, your stakeholders, continue to see the great value that you bring to the community. So with that, Megan, I don't know if you want to say anything else before I transition to questions.
No, that was great. Thank you.
Okay, Sheila, I would like to go in order, if that's okay, folks. What will happen is, as we get to your question, I will unmute your line so that you can ask your question to our panelists. So Steve Kabiru, if you're still on the line, I'm unmuting you so that you can go ahead and ask your question.
Yeah, thank you very much. Can you hear me?
Yes.
Okay. My question was, with the presentation was very, very good and a bit scary, but wonderful. We got the message. My question is, as we proceed towards recovery in Q3, that's towards the end of the summer, at the same time we'll be catching up with the campaigns. Does it look like we will be able to finance both the political campaign and also refinance our recovery? Thanks. That's my question.
Okay, great. So just so I'm clear, in terms of what you're asking, it seems like you're asking that the recovery is going to be coinciding with the presidential campaign. So how will that factor in to the presidential race? Is that your question?
Yes, exactly.
Well, it is very much changing the structure and the focus of the candidates heading into this election. Clearly, the economy was President Trump's main, flagship sort of campaign issue that he was looking for. And I don't think we've ever had a president get reelected during a recession. But as you point out, if we are in the recovery phase, and if the markets continue in the direction they're headed, we think that would be a support for President Trump. The polling numbers still seem to, they're kind of oscillating around depending on the news flow around the virus. I think this will be the focus. It was, not the focus in the primary campaign for the Democratic candidate, but the getting the economy back on its feet will be a key focus. So to that end, and I would also add the debt is going to be something that will be, I think, getting more focus, similar to some of the elections in the post-crisis period, where there was a focus on how to bring the debt levels back down. And so in that sense, you'll have two different responses. We're likely to see some proposals, which we were already seeing from Vice President Biden, to increase taxes on certain on corporations and certain individuals. That will be kind of likely his response to the debt question. And then President Trump will likely try to extend the tax cuts and look for an improvement in growth to try to offset some of the hole we've dug ourselves into. But it's a pretty bleak outlook from a debt perspective. So I don't know if that's any color on terms of how we're thinking about this, but all of those other ancillary campaign issues, antitrust regulation, pharmaceutical drug pricing, we think those are probably taking a backseat.
Thank
Great.
you.
Thanks so much. So Fisher, if you're ready to ask your question, I've unmuted your line.
All right, can you hear me now?
Yes.
Something that really highlighted to me problems ahead was my trip to the Acme markets today, and they had no fresh meats. I mean, none whatsoever. It just made me think that, or ask the question, are we really headed for food shortages? And when you look at a food shortage or any kind of shortage, there are certain segments of the economy that can recover or recover faster. But those organizations that support people at the bottom of the economic ladder, and particularly the impact on people at the bottom of the economic ladder, are we headed for food shortages? And will those if so, are we looking at that going out 6 months, 9 months, 12 months?
It's a great question. I don't have intimate knowledge of all the food supply chains. We have been hearing from some of the major companies, like Tyson, like some of the large pork manufacturing plants. They have had to shut down some locations because of the quick spreading of the disease of the virus in those locations. You tend to have workers. Meat packaging plants tend to have workers very close together, but those plants are trying to make the accommodations, and I believe the president did an executive order to keep them open, even if there's other enforcement mechanisms in the state or in the community that are keeping people and companies on lockdown. So the food shortage is a combination of some disruptions in the supply chain, but also the hoarding impact. And anybody who gets here's of meat packaging plants shutting down, there can be a rush to the grocery store to buy up everything they can and stock the freezer. I do think that whether this is a short-term phenomenon or something that's with us for longer will very much depend on the trajectory of the disease. What we do know from the science is that there are signs that heat and humidity have a dampening impact on the spread of the virus, which would suggest that we should get a breather from this in the summer. If we start to get some of the warmer weather in the US and across the US, we're likely to see that spread rate of the virus decrease. And hopefully that buys enough time for the therapeutics to progress, for companies, meatpacking plants to get the necessary restrictions in place and distancing protocols such that they can be open if we do get a second wave.
I have a list of all the lesbian couples and their email addresses and phone numbers and the kids' names.
Pardon me, I think that we
goodness,
need
I'm
someone
sorry.
to mute. Yeah, thank you. Sorry, Megan, if you want to continue.
That's okay. So that's kind of it. I wish I knew, personally and for all of your benefits as well, what the likelihood of a food shortage is. We are seeing, from what we're seeing though, it is a lot less disruption and breaking of the supply chain as it is kind of the demand just increasing. And typically if it's hoarding, it would be a short-term demand bump. And then when everybody's, can't fit anymore in their freezer, or they've got all their closets filled with toilet paper, that demand comes back down and these supply chains see less strain.
Okay, thanks, Megan. So next is Kathleen Rutherford. If you want to unmute your line, I can go ahead and do that for you if you'd like. Kathleen? Okay, we're gonna go on to the next person.
No, I'm here.
Oh, okay, okay.
Yeah.
Go ahead and ask your question.
Yes, thank you very much for organizing this today. And so some of the clients that I service are in the nonprofit sector. And, as an independent sole proprietor, I'm finding zero answers to, don't qualify for a PPP. There is no, we have been told many times that there are, forms coming out that sole proprietor, independent contractors can fill out, but just really nothing solid in the pipeline right now. And as a financial institution, just want to know any suggestions other than those two avenues.
Yeah, so I don't have any kind of specifics in terms of either the intricate minutia of how these programs are, every specific situation, who's applicable to them. It would probably be a better question for somebody more on the bank side, maybe an M&T bank, who's dealing with the different loan requirements that they have. Unfortunately, I don't have a great answer for you there. I'm sorry.
Okay.
I could add that Congress is planning to come back with, I think they're calling it the CARES 3.2.5, 4.0. So there may be some additional stimulus dollars that might look at that, but it's hard to tell right now.
Thanks.
Have to unmute myself. Next up is Lou Salvadori. Lou, if you'd like to ask your question.
Yes, Megan. I think there is no correct answer for this. However, I'm going to ask it anyway. The historical evidence is that in pandemics, that includes the Spanish flu, Ebola in Africa, that the second wave, which for COVID-19 will be in the fall in the Northern Hemisphere in October, November, are considerably higher than the initial waves. And while we all hope that the recovery can take place in the third quarter and continue on, that the CDC, the World Health Organization, are very cautious about saying that things are going to return to normal and that this recovery will continue. So I just, wanted to get your thoughts.
Yeah, I think you make great points, and those historical patterns are a little bit discouraging if they do hold true for what is likely to be, hopefully based on the data we've seen in the science and the studies, slowing of spread during the summer, and then what is likely is that second wave that you talk about as the weather gets colder, particularly in the Northeast. I think what I would caution against is relying too heavily on what happened with the Spanish flu, for instance. We have a much more integrated integrated medical response, everybody pulling in the same direction from a therapeutics development perspective, as well as the government throwing their full force behind reducing time to, expediting studies, expediting these trials, and trying to get, even offering support for manufacturing at scale if we do get something, if for example, Gilead's drug does prove to be really useful in reducing some of those tail risk occurrences. So my only caution would be, I, for one, have a hard time betting against the smartest minds and the progress we've made in the pharmaceutical therapeutic field, as well as I said, a vaccine that starts to get traction by the end of this year. We just do not know what will be the policy response. You could see a situation potentially where the government basically takes that vaccine, the code, distributes it to everyone, says nobody's going to make any money off of this, but everybody needs to produce it. I don't know if that is possible or it could happen, but I think that this time around we do have the incredible science developments that are taking leaps and bounds much quicker than in the past, and then you have policy support specifically as it relates to reducing some of those hurdles to getting drugs through the pipeline and produced in mass.
Okay, just want to be respectful. We have 2 more questions. Megan, do you have time, or
Sure, yeah,
okay.
we can do
Great. So Fran Lutz, if you are ready to unmute and ask your question.
Sorry, thanks, Megan. This is a quick question on the statistics that you had posed earlier related to the change in the revenue from the nonprofits. I just wanted to know whether or not that included churches and religious organizations in those figures or not, and whether or not you think there'll be any impact with the obviously stay-at-home online church services impacting donations into churches and therefore impacting donations into nonprofits that they would typically support.
Fran, I can answer that. The data that we have are from IRS tax forms 990. So if a church, which they're not required to submit a 990, the data probably doesn't include many faith-based congregations in the historical data. I would say though that churches, and I have some personal experience with this, they're like other nonprofits. And so in some ways, the online service that you've provided helps to create connections to your congregants. How that translates though into donations, I think, is new territory. And so don't necessarily have a forecast on that, but I think, one of the things that I'm hearing from nonprofits and faith leaders around what it means when we come out of the, into what we call phase 2 of emerging and then phase 3 is to the degree in which people feel comfortable congregating back in spaces. So as part of your strategy and thinking forward is what will your organization do, your church do to create a safe environment for folks to be able to come back in and feel comfortable to be together again?
Okay, great. Thanks, Sheila. Mike DiPaolo, if you'd like to unmute to ask your question.
Thank you. I was just wondering if you see any of the actions that the federal government or the Fed that they've taken. Do you think any of those might become permanent or become part of whatever becomes the new normal in some way or fashion?
Good question. Well, I think some of the stimulus that's been put in place by the federal government, some of those lending programs, I think that we do have we'll see if they do work. Again, one of the main cruxes of the small business lending program was to try to extend loans that would convert to grants if companies quickly rehired workers. Of course, we don't know if that will play out. If that is successful, you could see that being part of the future playbook. I don't know about, certainly not extending that aspect permanently, but maybe for future recessions, that would be something that they go to quickly. Of course, there is a, tremendous elephant in the room, which is the debt situation. And I don't know that this type of response is sustainable. It is, we were already in a precarious position from a long-term debt sustainability standpoint. And the last 6 to 8 weeks have taken us in a meaningfully worse direction. From the Fed standpoint, what we've seen so far is some new kind of measures, particularly purchasing of municipal bonds, purchasing high yield bond issuances, or those that have fallen from investment grade into high yield. That's something that the Fed has never done before. They're clearly getting more comfortable extending their reach into different areas, extending it out the risk spectrum. So I think in that sense, the Fed may have more tools at their disposal in the future. But what we see is that every time, now that we are at the so-called zero bound for the Fed funds rate, that is, the Fed funds rate is at zero, they have to kind of look to these other tools, quantitative easing, asset purchase programs, and different ways of easing liquidity. The one thing that I don't think we'll see in the US, we don't anticipate, is a sustained negative interest rate environment. That's something we have seen in Europe, we've seen it in Japan, and some other parts of the world that has not really been successful. And central banks are trying to mitigate against the risks of that. So we don't think that at this point, negative interest rates broadly in the US look likely.
Great.
Thank you.
Thank you, Megan. And thank you, everybody, for your time today.
So Sheila, I know we have to wrap up, but there is one quick question that I think you can answer rather quickly.
Sure.
And it's relating to if nonprofits could create a rainy day fund as a group. Is there a possibility of this?
Well, that's an interesting idea. Well, let's talk about that. Follow up in the future on that.
Yes.
Great, thank you.
Okay, great. Sorry, I didn't mean to interrupt.
No, it's just wanted to wrap up just because I feel like, this kind of subject is a little bit sobering, but I do think that with this kind of information, it gives you a place that you can begin to plan and to think about what kind of future you want to create, how you create it. And if Dana can be of help, I've listed the Dana team members there. Any one of us, if we don't know the answer, we'll help you get it. Thank you all again today. If you don't mind, we are sending out a brief survey just to get your feedback, and hope that you have a great day. And Megan and Rick, thank you so much for being here today. I really appreciate it, and certainly have given me some really great things to think about.
Thank you for having me. It was a pleasure.
Thank you.
Right, great. Goodbye, everybody, and thanks again. Have a good day.
Thank you.
Thanks, Melissa.
I'm muted. I know you have another meeting, so I'll talk later.
Thanks so much for your help. I appreciate it.
Sure.
Yeah, thanks, Melissa, and thanks again, Sheila. Appreciate it.
Thanks.
Thank you,
Good luck,
Rick. That
Rick.
was wonderful. Thank
That was
you.
great.
Good. Thank you. All right. Bye-bye.